If you're like me and you've been in the stock market every day, then you know everywhere you look, you're seeing the same headlines. The stock market is crashing. Investors need to panic. The recession is coming. And naturally, that makes people ask the same kind of questions, right? Everyone has the same questions right now. Should I be worried? Should I sell? Should I get out of the market completely? So today I'm going to break this down clearly for you so you understand what's actually happening in the market, what long-term investors should be doing, and how to use a flex financial approach to profit during this volatility. So let's go ahead and get into it. What's up, YouTube? Welcome back to the channel. Now, if you're new here, this is a Flex Free Game channel, and it's all about giving you free game in the market, really just so you understand how to stay ahead of what's going on in the market and so that you have a good idea of what to do to be successful. So what's actually going on in the market right now? Let's talk about some of the main forces driving the market. One is interest rates are still elevated. So when interest rates are higher, that makes borrowing money more expensive, and that slows down business growth, which reduces investor appetite for stocks. The second thing is certain growth companies are getting revalued. So as these companies are getting revalued, growth expectations are adjusted downward. Their stock prices fall to reflect lower projected future earnings. The next thing is institutional money is rotating into safer assets. So large funds are moving out of stocks and into bonds or defense sectors. That reduces demand on equities and pushes prices further down. And then lastly, volatility is rising, which increases option premiums. Increased volatility signals uncertainty and fear in the market, and often causes investors to sell stocks and drive prices lower. So none of this means that the world is ending, and none of this means that the market is broken. This is actually a normal phase in the market cycle, but how you respond to this is going to determine whether you grow or whether you lose during this market cycle. Now let's jump into why most people lose money in the market. So most retail investors lose money because they react emotionally, right? Instead of having a plan or reacting strategically, they buy the hype, right? They panic on dips, they sell low, and then they repeat, right? So they just kind of follow the market cycle. And when things are going well, they jump in. It's like, oh man, everything's going great. I'm gonna go ahead and buy, but they're buying towards the highs. And then what eventually happens is the market has this downturn. Big time investors will start taking profits, driving prices down. Some of the things I just mentioned in the earlier segment will drive prices down. And then what happens? The panic sets in. Retail investors feel that panic. They react emotionally. They sell at the low because now the stocks have dropped. And they do that and they repeat, right? So they keep riding the emotion of the market. So they're always buying at the highs, always selling at the lows. And what we want to do is more along the flex financial approach, right? So we want to evaluate these stock markets and companies and stocks like a business owner would. So we want to understand the business model, right? We want to understand how these companies we're investing in are making money, how they will continue to make money, how they're doing currently in the different verticals that they're in. We also want to look at their revenue, right? So we're going to look at the top line revenue. We talk about that a lot. We're going to look at margins. We're going to look at cash flow, and take those things into account when we're making decisions on, if we're going to stay invested, if we're going to buy, we're going to sell. We also want to assess leadership and debt. So there sometimes are changes in upper management, or you may know a little bit about, what's going on in terms of leadership. But if not, we want to make sure we're doing that research, make sure we understand where they're driving these companies, what's top of mind, and also how they're handling debt. And then lastly, we want to determine a fair valuation of these companies, right? We want to understand, what are these companies worth? What are these share prices actually worth? And are they at a good price that I want to buy? Are they at a price that I want to sell and take profit? Are they at a place that I want to stay invested, right? So we want to take all that into how we're understanding what we're investing in. And that'll help us with eliminating some of the noise that we hear in the market. And again, reacting to things emotionally so we can start to make data-driven decisions and start to invest the right way. Now, while most people fear volatility, we like to use it to generate income in our program. So the strategy we like to use is called cover calls, or selling cover calls into the market. And one way you can do this is if you already own 100 shares of a company, right? And I want to say of a quality company. So when we're going in and we're buying shares or we're, investing in companies, we want to go ahead and make sure that we understand the business, like I talked about before. We understand what the charts are doing. We understand the top line revenue. We understand, everything that we can to make good data driven decisions on investing in these companies. So when you own 100 shares of these companies, you have the ability to sell a call option on those shares. And that gives you the right to go ahead and give up those shares at a certain price at a certain date that you choose. But the best thing about that is you collect a premium, right? So the income that you get from these is called a premium. You get that cash up front. So every time you sell a call, you're getting cash premiums right into your account. And one thing that does is it reduces the risk of downside while you're holding these investments. And another thing is it allows you to generate income on these. So if you happen to be in a quality company that's on a downturn right now, you can sell cover calls against that so you can bring in some cash premiums while the stock is down, and just bide your time until it turns around. And then once it turns around, you're still in a good spot. Another nice thing about these quality companies, that they pay dividends, that's going to give you a little bit more security as well. And how dividends give you security is, one, you're going to bring in some additional income. So every quarter, every month, whenever that company pays out their dividends, you're going to bring in some additional cash. But one of the best things about this is dividends are incentives for big institutions to stay in companies, right? So let's say you're holding a company like Apple, and all these big institutions are holding shares. Let's say it pays $1 per share, just as an example, and they own 1 million shares, right? Even if that stock is down, those big institutions are generating $1 million per quarter just for holding those shares. So that's going to incentivize them to stay in the stock, which will keep the stock from falling completely off the cliff, like some other stocks that don't pay dividends do. And that's going to give you some more security when you're holding shares of a company like this. And along the way, you're taking in cover call premiums, you're taking in dividends, and that all of these things work together in your benefit to keep you ahead of what's going on in the market. And here's the key to this for right now within these market conditions, right? So when volatility increases, premiums increase, meaning we get paid more for the same trade. So if you're already doing cover calls and you have quality companies like I talked about before, when this volatility rises, the implied volatility raises the rates of the premium. So you're going to get more cash while you're taking in these same premiums, doing the same trades that you would be doing. And this is why we like to say we get paid to wait, right? We're getting paid more to wait, hold these shares, and continue to take in higher premiums. So when we get those premiums, we can do a few things. We can buy more shares of quality companies. Right now that the stock market has pulled back, these shares are going to be at prices that are on sale. I like to call them being on sale because they're lower than at the highs. You can buy them for a lower price. We also can increase our compound growth, and we can accelerate our long-term wealth building, right? So all of these things we have the opportunity to do when the market is in these conditions, so we can take advantage of it as long as we have the right mindset. So is the crash coming? Now, no one knows exactly, right? We don't know the exact day, the exact month, the exact hour. Analysts don't, influencers don't, economists don't. And honestly, I don't really care if the market is going to crash, right? If it's going to go down, it's going to go up. We know that the market is cyclical. We're going to have times where the market is running. We're going to have times when the market pulls back. But we do know one thing. The market always rewards preparation more than prediction. So if you can do these few things, you'll be able to be successful. You own quality assets, right? We talk about making sure you're understanding what you're investing in, make sure that it's quality. You're generating consistent income, right? We talked about one way to do that with our cover calls, and there's many other strategies that you can do as well. Another one we like is bear call spreads. I won't get deep into that today. And you want to reinvest intelligently, right? So as these share prices are coming down, as long as you still understand the company, you understand it's a quality company, nothing within the business changes, all external factors that are kind of driving it down lower, then we can use these opportunities to reinvest and build our positions. And then volatility becomes an opportunity instead of danger, right? So we're not looking at the market emotionally. Again, we're using those data-driven decisions, the ability to kind of understand what's going on and take advantage of it. And if you have cash on hand, there will be some great opportunities when the market turns around. So if you found this information helpful, I do want to invite you to our free upcoming webinar. So we're going to be putting on a webinar where we're going to go ahead and evaluate stocks with confidence. We're going to show you how to do that. We're going to show you how to generate income using our cover call strategy. We're going to build strategies that around compounding long-term wealth with long-term investing and some other things that we can do in the program. and we're going to apply the full Flex Financial approach, show you exactly what we do in our program so you have clarity on what to do and how you can be successful. So all the information that you need to join this free live workshop is going to be in the description below. The workshop is called Flex Financial Trading Presents From Paychecks to Profits, live trading and investing workshop. So you'll see that. You'll see some other things about that coming up. But we'd love to have you. Think it'll be a great way for you to kind of understand what we do in our program and how you can start using these strategies to go ahead and start having some success in the market. And again, it's free, totally free. So go ahead and check it out. If this brought you any clarity on what to do in the market, how to handle these downturns, things like that, go ahead and hit that like button. Go ahead and subscribe so you can see upcoming content. And we'll see you on the next one. Have a good one.